Hello everybody, welcome to this new video for Tuesday, the 27th of August. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. It's running towards the end of the month of August, so traditionally we're going to take a look at the seasonality for the upcoming month, that'll be September. And what I want to do is go over the various sectors, look at their relative strength using relative rotation graphs, and look at the individual charts to see what's happening in terms of price. And because there's a lot going on in the markets right now, if you look at participation, it seems that that is broadening. So there's more markets doing well, or more sectors doing well. If you look at the individual breadth measures of stocks trading above moving average, new highs, etc., that's all looking pretty good. But there's a few important sectors that are struggling, and where we had a situation that it was only one or two sectors that were driving the market higher, it is now a lot of sectors that are doing well, but in terms of market capitalization, it is now those sectors that have been doing well are not yet under pressure, but they're running out of steam, or so it seems. And I want to go over and check the individual charts to actually see whether that is true and what we can learn from that for the weeks ahead. So let's get started and dive right into a start with seasonality. Let's kick off with a look at the seasonality for SPY, the S&P 500 itself. And the way I do that is I use the seasonality tool on the website and I set it to the maximum of 20 years. And then I scroll 1 year back. And the reason is because 2024 is not complete yet. So if I would use these settings like all the way through, you will see that it changes a little bit instead of doing 1 year back. And the reason for that is that this chart has now been updated all the way up to July. And if I do it like this, it goes to completed 2023. So this is everything, and I'd like to use the entire year as my predictor or my guide for the entire next year. So 2023 and 20 years prior I am using that during all of 2024 to look at the seasonal patterns. Now what we see here for SPY is that we're in the middle of a very flat period. You can see that SPY in any way is basically only showing two more interesting periods, which is the start of the year where it continues to rise. And then you see a little dip with this exception here in July. And then there's an exception in November. But this period here, with 60% of the occasions SPY closing higher than it opened, because this is a price-based seasonality chart. We're not using any relatives here yet. We're going to do that when I open up the spreadsheet. And what you see is that this whole period, August, September, October, is kind of a dip, summer dip in the seasonal pattern of the stock market. So there's not a lot of conviction in these periods of outperformance. 60% of the time is okay-ish, but it's not a super convincing number to basically get very enthusiastic about. Especially not when you look at the average returns, because on the bottom here we got the average returns for every month. And now it's getting interesting because this is one of the few months where, on average, the stock market declined minus 0.6, so minus 60 basis points. In the last 20 years, on average, the S&P 500 SPY declined 60 basis points, 0.6%. And it's the only month, together with June, which is only minus 0.1, where the market on average declined. Now the fact that we're still at 60% of the months closing higher than it opened means that even in the 60% where the market had a positive return, that wasn't enough to offset all the months with a negative return, causing that minus 0.6%. So my take here is that even if it's a positive month, it's going to be very, very minimal. And if it's a weak month, it's probably going to be pretty weak, because in 40% of the time when the markets went down, is causing a minus 0.6% return. So all in all, the seasonality for the S&P 500 as a whole is not looking very strong. Let's move from SPY itself to the sectors. And I'm going to use this spreadsheet that most of you probably already have seen. If you haven't seen it and you would like to have a copy, just drop me an email and I'll be happy to share it with you. It lists all 11 sectors and SPY itself, and it's broken down into offensive, defensive, and sensitive groups of sectors. And here is the 60% outperformance that we just saw on that seasonality graph. And the other numbers here are relative performances, relative percentages. So the way you read this is for the month of September, materials, XLB, in 40% of the time outperformed the S&P 500. So 60% of the time it underperformed the S&P 500. And when we move to the section below, we get the average relative performance for that sector versus the S&P 500. So here for materials, it's minus 0.6%. What that means is that on average, over the last 20 years, materials underperformed SPY with 60 basis points. So the average return is minus 60 basis points for SPY, minus 60% underperformance. So that's on average a minus 1.2% average return for the materials sector. And you can check that by bringing up the seasonality chart for the materials sector and just run it on just the one that I had for SPY, change that number to XLB, scroll it to 20 years, 1 year back, and you will see that the average return for the materials sector over the last 20 years is minus 1.2% in the month of September. And we can do that for all the sectors. Now, I'm not getting super enthusiastic when something's around 50%, because that's a toss of a coin, 50-50. And even 60-40 is not something to get super enthusiastic about. It's not super meaningful. So when do we think that is a meaningful number? For me, it's probably 70% and higher, and on the flip side, 30% and lower. Although that lower doesn't really happen very often. 70 and 30 are kind of the maximums. If you look at the total grid here, then you'll see that in May, communication services is 81%, and you will see that industrials in November is at 85%, and then we've got a 75% for utilities, 80% for SPY, 75% for SPY, 80% for SPY in November, so we're going into a good month. But that's about it from, if in terms of to what kind of maximums you can get. So when we zoom in on the numbers for the month of September and we break it down by these three groups, I think we can see that for the offensive sectors, materials, financials, real estate, and consumer discretionary, we are all at an average or below average. So 40% and 60% and 55% are all around the midpoint. And then there is real estate, which has a relatively low number at 35%. If we look at the accompanying average returns or relative returns, then materials, we'd already seen, is expected to be the lowest, the weakest. And then we've got financials, which is expected to be in line with the market, because 0% outperform means in line with the market, so there's a 60% decline. And then we've got real estate, which is expected to do 20 basis points under SPY, so that would be minus 0.8. And then we've got consumer discretionary, which is expected to do 40 bips over SPY, but it still means a price decline of 20 basis points on average in the month of September for the consumer discretionary sector. So these numbers are not particularly exciting, not from a expectation in terms of outperformance at a sector level, nor at a level of average performance or relative average performance. If you go to the defensive group, then we see utilities sticking out at 30%. What this means is that 70% of the time the utility sector has been underperforming the market. And then consumer staples and healthcare are both at 50, and that's, the toss of a coin. If we bring that to average performance, then utilities are expected to perform 30 basis points below the S&P 500, and then staples and healthcare on average are 20 bips above the market, but in this case it means that they are still showing a negative average return over the last 20 years, in line with the 0.6 decline for the market as a whole. We do need sectors that are going down on average. And then finally we have this group of sensitive sectors. That's communication services, that's energy, that's technology, and that's industrials. And here also 56, 60 and 40 are kind of middle of the road. And then we've got industrial sticking out at 70. So 70% of the time the industrial sector managed to outperform the S&P 500. And translating that to returns, then we see that communication services on average is outperforming the market by 0.1%. Still means an expectation of a minus 0.5% in price terms. Energy up 70 basis points over the market, so that's a slightly positive expectation for the energy sector, only 0.10%. Technology at 0 is expected to be in line with the market, so a decline of 60 basis points. And then here's interesting, here we have our industrial sector, which is outperforming or expected to outperform the market 70% of the time, but the outperformance is 0.5%. It's the high, well, here is energy is higher with 0.7. It's 0.5%, second highest expectation, but with a market decline of 60 basis points, this means an expected return for the industrial sector, which is still in negative territory. All in all, what we see here, or the way I read this, is that we're hitting a weak month, a weak seasonal month for the market, the weakest month of the year, and the expectations for the sectors are not deviating much from their averages and not giving us a lot of guidance because they're very close to 50%. The only two that are probably standing out are utilities at 30% and industrials at 70%. And utilities is giving us an expectation of 30 basis points under SPY, and industrials is giving us an expectation of 50 basis points over SPY. In both cases, it means a negative return, a negative expected return for those sectors. Not a lot of good stuff. Overall, a negative tendency from the seasonal picture, and expected outperforming sectors, pretty much only industrials, and then not even by much. The only sector with a positive return expectancy is energy, with 0.1% in terms of price and 70 bips over the S&P 500, and it's got 60%, so that's combining these two, energy might have an edge. But what we're going to do is we're going to plot these sectors on a relative rotation graph and see if we can find alignment for utilities, energy, and industrials. So from the theoretical sector rotation, or from the theoretical seasonal patterns, we're going to take a look at the actual rotations as they are taking place right now. And I'm going to do that into those three groups. So starting with offensive sectors, you see the RRG right here. And the immediate catch is the strength for the real estate sector. That's a really long tail, moved into the leading quadrant, and actually has a pretty positive outlook. You know, if I look at this tail here, I'm going to expect that real estate is going to continue this move into the leading quadrant in the next couple of weeks. And that is disagreeing with the expectation from a seasonal point of view, because the real estate sector is has a 35% chance of outperforming, or 35% of the time over the last 20 years, this sector outperformed going into September. This looks different. This looks as if this sector is actually going to outperform. It looks pretty good. The same for financials. Financials is actually on its way towards the leading quadrant. And here also financials is at a 55%, so that's a bit of 50-50 odds. And the expected return for financials is in line with the market. So still a negative return for the sector, but in line with the market. And you know, if it's a little bit above it, then this tail will move into the leading quadrant. Consumer discretionary is losing pace already while still inside the improving quadrant. And materials has the lowest reading in terms of RS ratio. And with it has, as we saw on that grid, has a very negative expectation for the month of September. So for the cyclical sectors, the real estate and financials are, in my opinion, moving counter seasonals. And consumer discretionary and materials are in line with what we expect from the seasonal pattern. Real estate and financials obviously very interest rate driven sectors. There's a lot going on in interest rates at the moment. So that's probably the underlying factor that is driving these sectors. But all in all, this group of offensive sectors is at best in line with the market, with the exception for real estate and maybe financials. But I don't think and I don't see how this group is going to drive the market higher, because there's no super strong seasonal expectancy, especially not from a return perspective. And you know, if you want to drive the market higher, you need to put in higher returns. You need to outperform the market, but you also need to show positive returns. And that's not the case for this group of sectors. We move on to the group of defensive sectors, then this is an interesting RRG. If you look at the expectations from a seasonal point of view, utilities is expected to underperform. 70% of the time, the utility sector underperformed the S&P 500. And staples and healthcare are at 50%, so they're 50-50. And from a return perspective, they all have a negative return expectancy in terms of price, and utilities expected to underperform the S&P 500. Now, when I look at this RRG, that looks different. Utilities is on the right-hand side. It's at the highest RS ratio reading of this group. But look at the rotation that just took place over the last few weeks. We had this negative rotation, and then all of a sudden, all three of these defensive sectors started to improve. And now you can see that they're all three at a very strong RRG heading, which means that they are gaining on both the RS momentum and the RS ratio scale. And when all three defensive sectors are rising and are at a strong heading, and look at the returns here. So over the last, this is 10 weeks, they've all outperformed the S&P 500. And when I bring that to, say, 5 weeks here, then all have outperformed. The last 5 weeks, all three sectors have outperformed the S&P 500. This is a situation that is not, usually not in line or accompanied with an overall bull market. And that's one of the problems that I have with the market as a whole. And we'll look at the chart of the S&P in a minute. I think there is a lot of overhead resistance coming in, and yes, I do see, we'll look at that in a minute, but this is something that I keep in the back of my mind as a warning signal. This for me is a red flag. Healthcare, staples, and utilities all moving higher, all rotating inwards and heading towards the leading quadrant. That is not the type of rotation that belongs to the middle of a bull market or a starting bull market. We've seen this before at the end of the previous rally, where all of a sudden these three defensive sectors were the ones that were driving the market higher, and then all of a sudden we got that decline. I think this is at least something to watch. It's a red flag for me, and it's holding me back to become super bullish on the market as a whole. And let's finally go to the group of sensitive sectors. And here we have communication services, technology, industrials, and energy. And we had energy and industrials as the outliers, as the positive outliers, both still with a negative return expectation. That is a bit of the weird thing. So when industrials is outperforming, it is outperforming very hard. So the outperformance is 50 basis points, 0.5%, but with a market expectation of minus 0.6, that means that industrials, on average, dropped 0.1% in the month of September over the last 20 years. Now look at these rotations. They are, except for technology, technology is rotating out. The negative rotation for technology is clearly visible. The weekly RRG is just hitting the lagging quadrant. And the expectation is that technology will continue to underperform the S&P 500 going forward. So if we bring this to 5 weeks, boom, 5 weeks, you can see how only communication services has outperformed. All others, including industrials and energy, have underperformed the S&P 500. They're still at very low readings, and technology is now clearly rotating out. So the positive expectation, the expectation for industrials and energy to outperform the S&P 500 is still possible because they are on a positive trajectory, albeit at very low levels. So for the next 3 to 4 weeks, I mean, it is possible, but we will still be on the left-hand side. We will still not be in a relative uptrend versus the S&P 500. So taking it from this picture, putting it all together with what we saw in the rotations in those other groups, I'm going to expect that maybe industrials and energy are going to outperform or perform in line with the S&P 500, but I'm not going to expect a super strong outperformance of either of those sectors. The only one which has the better odds is communication services. It's right now right in the middle. It's at a positive heading and it's almost inside the leading quadrant. So if something's going to go, then it's probably going to be communication services. Bringing all this together with the mixed bag in offensive sectors, the clear strength in defensive sectors, and then here again, a mixed bag in sensitive with a very weak rotation for the technology sector, which is undeniably a very important sector for the US stock market. I'm going to conclude that the S&P will have trouble to rise aggressively. I'm not going to rule out that there's going to be a little rise, but I'm going to look at some charts in a minute. There's a lot of overhead resistance, both in SPY and in some of the sectors. And that's holding me back to be all out bullish for the S&P 500. Mind you, doesn't mean that I'm all out bearish because there's no lower highs, lower lows yet. There's no super negative rotation. For that, we do need offensive sectors to actually start rotating out and show very, very weak relative strength. And preferably also for some of these sensitive sectors. Technology is already there. But when we see industrials and energy rolling over and turning back into the lagging quadrant, that'll be the sign that the market is in more trouble than it is right now. But there's still a ton of red flags and warning signals to at least prevent me from going 100% long in any equity portfolio. And to wrap it all up, let's quickly go over the individual charts for the sectors. I'm not going to talk long and a lot about each and every sector, but just to get the gist of what's going on, just browsing through these charts, as you may want to do on your own installation of stock charts, your own chart list, etc. Giving you a little bit of my background. So we start with materials. The way I look at it is it broke out and it's now having trouble with this overhead resistance here around 93.30. You can see that the relative strength is still in a downtrend. The RRG lines are picking up because the momentum of that relative strength is slowing down, and that's causing these lines to turn up, but the RS ratio is still well below 100, so still in a relative downtrend. We go to communication services. Same story. We're pushing against resistance. We're pushing against overhead resistance. And you can see how the relative strength line is moving sideways. That's why XLC is right in the middle of that RRG, because a sideways move, almost straight line sideways, is in line with the market. If the line moves up, we're outperforming the market. If the line goes down, we're underperforming the market. When the line goes sideways, we're in line with the market. And you can see how those RRG lines have come back to 100, and they're now almost at 100. So that's in line with the market, pushing against resistance. If you go to energy, then we see the breakout, but the subsequent dip back, and there's quite a bit of overhead resistance waiting. This is 94. I should have put in that line there. 94, and then here is 99. And you can see how the relative strength line is trying to find a bottom. The RRG lines are improving. That's why it is, inside the lagging quadrant, but very close to getting into improving, but still at a very low reading of the RS ratio scale. So not an all-out bull market, neither in price nor in terms of relative strength. The financials, I'm going to use the non-adjusted version. This is probably, from a price perspective, one of the better sectors. You can see how it just broke above its previous resistance. That happened already last week. We're still holding up. So this is Monday's price action here so far. Higher highs, higher lows, coming out of that ascending triangle. Doing pretty good. And you can see how the RRG lines are improving. The red strength line needs to get out of this sideways range. And that's why it's on the RRG, if you can remember. Positions on the left, inside improving, and moving towards the leading quadrant. So from a relative perspective and a price perspective, probably one of the better sectors. Then here is industrials, the sector that we looked at from a seasonal point of view as well. This is the best performing sector in terms of seasonals, and it seems to be supported by a breakout in price. It's still very early. Last week was narrowly above a new all-time high, and then yesterday we were holding up, but we still have 4 trading days to go. You can see how there is some sort of improvement in terms of relative strength. So if that seasonal pattern works out a little bit, then this could be supportive of that, despite the fact that we're still way to the left, as I explained to you when we were looking at the relative rotation graph. Here's technology. Again, this is the sector that is underperforming, that is rotating out of the leading quadrant, just moved into lagging. And you can see how the price had a big swing. We broke out of that rising channel, then got back into it. And when you get back into a former rising channel, the odds of testing the lower boundary are pretty big. That happened. And we're now bouncing and we're back inside that rising channel. But the question is this going to be the first lower high to be formed? Because we do have a first lower low. Will this be the first lower high? And will it continue? I think we will have plenty of time to analyze that and notice it when it happens. But please be aware of this, that this could be the first lower high. I think the area around 190 is going to be super important for the technology sector. And also this trading range in terms of relative strength If that gives way to the downside, we're going to expect an acceleration of relative weakness going forward. Here is consumer staples. We saw it, one of the stronger rotations. You can see how after a little dip, staples are back on the upside in terms of relative strength. We are waiting to break this overhead resistance in the RS line. We're coming out of this long period of underperformance, long downtrend for relative strength, and the price trend is absolutely strong. It's one of the stronger price charts among the sectors. Here we've got real estate. I'm going to use the non-adjusted version for that. You can see how that relative strength seems to be turning around, or at least is trying. The RRG lines have already picked up a new uptrend here, so the RS ratio is above 100, and you can see how the price chart is actually helping that. We're not nearly breaking to new all-time highs, but this is a good sign. We're breaking out of a, what's that, 2-year overhead resistance. So that's a strong sign, and we're holding up well so far. So in terms of price, real estate's actually one of the better sectors, and that's getting supported by stronger relative strength. And then utilities, again, not pushing to all-time highs. We're nearly there, but this break is strong. We see the turnaround from relative strength. The downtrend in terms of relative strength seems to have ended. We're trying to find a bottom here. We do need to take out this overhead resistance, which is 0.14 in terms of relative strength. But more importantly, the RRG lines are inside the leading quadrant, and the RS momentum has just returned back. So we just made a rotation from leading into weakening and now back up into leading, and that's usually a very strong sign, and it's going to be supported by a strong move in the price chart. And then healthcare, one of the defensive sectors. Here also a long winding downtrend that's about to reverse. The RRG lines are picking up the first signs of strength, and in terms of price, it's actually one of the stronger charts. It's interesting to see that when we go over all these individual charts, that the breakouts to new highs are actually for utilities, staples, and healthcare. And you know, there is, well, not utilities, but staples and healthcare are breaking to new highs, and that is a good sign. But they are defensive sectors, so please be aware of that. And then finally, we have consumer discretionary, which is in the middle of a very broad trading range. No higher highs, but also no lower lows. Relative strength just broke below horizontal support, but it seems to be coming to a standstill, so it's moving sideways. So we got sideways moving price and sideways moving relative strength. Looks to be going nowhere in particular, but wide swings are possible. This is a pretty wide trading range, so you can get some pretty big swings in terms of price. That'll definitely affect the moves in relative strength, but there's no overall super strong trend, at least not at the moment if you ask me. So a bit of a mixed bag in terms of consumer discretionary as a sector. And then the chart of SPY, S&P 500. Here's the weekly version, and you can see how after testing this former resistance as support, we rallied back towards the all-time high level. So it's 565.16. That's the previous high a couple of weeks ago. We're now closing in on that area, but with all the sectors that I just showed you and the most important ones pushing against resistance or well below resistance, and only the defensive ones going to new highs and pushing higher, I think it's going to be a hard nut to crack for the S&P 500 to actually take out that previous all-time high in this run. So the decline, again, is going to tell us a little bit more of what's going on right now. We're running into resistance at an index level, and we're also doing that in a number of important sectors. If you look at the RSI and the MACD, I had these on my charts for a couple of weeks already. These negative divergences, although I'm not a big fan of this one here because it already dipped below. But if we got the MACD here, that's still diverging and still not there. That's a pretty serious warning signal for me. So in terms of potential and risk, I think that the potential is around 565, that's only marginal, and the risk is all the way down to this now rising support line, which is 516. That's a pretty decent decline again. And then we've got 510, which is the ultimate level of support, I would say. If we bring this to the daily chart of the S&P 500, obviously you see the same move, just in a little bit more detail. And we can see how this is 1, 2, 3, 4, 5, 6 days. We have marginally higher highs, but you can see how this is a block of resistance, like supply coming in every time. It's something like that we had right here. Here we had a negative divergence building up. I could argue that this is a little bit of divergence. It's not massive yet, and it's not above 70, but you know, it is, the last moves are not confirmed. And obviously this 565 is a pretty decent resistance area. Again, in terms of risk reward, at the moment your reward is limited to 565, and your risk is all the way down to 54, 540 on a shorter term level. Maybe the gap area here, which is 548, 544. Anyway, a lot of sectors running into resistance. SPY running into resistance. Seasonal expectation for SPY negative for the coming month. And pretty much only the industrial sector and maybe energy potentially outperforming the S&P 500. Going into September, I think we're gonna see a sideways to down month for the market as a whole. My 2 cents for this week. I hope you enjoyed watching. Thank you very much, and I'm looking forward to seeing you again next week, same time, same place.